Hey everybody, Chuck Barone here. It is Tuesday, August the 1st. We're turning the page on another month here. A great year of 2023. We're off and running on another crazy week here. Lots of earnings coming out today. Looks like most of these companies still doing okay. But before we get rolling, let me, of course, welcome everybody to the show. Thank you guys for your support. You guys hanging out with us every day, it means the world. It keeps us going, guys. We appreciate you guys staying with us. All right, so let's look at these markets today. Stock market mixed. I think the market now digesting the where are we? You're looking at the numbers. It looks like businesses are still earning for the most part, especially the businesses that are not so interest rate sensitive, right? Like real estate, higher rates really wipe it out because of the financing. Cars, even with the financing there, seem to be doing okay. You know, buyers living with gigantic payments and dealing with it. So the economy, employment's still strong, jobs going, report today looking pretty good. So the economy seems to be okay. It's the mood that isn't. People just don't feel like things are good. And I get that because I don't either. Yay, real estate. But, if you look at the overall data that we're getting, the economy hanging in there, I still got to see this soft landing with my own eyes to believe it, guys. I got to tell you, I have my doubts. I'm waiting for, this is like, do we really get the perfect landing? Do we really get to have this inflation, have all these signs of recession, having the mood as sour as it is, and come through with all of this and all these rate hikes and everything else and not have a recession? Is that possible? We're going to find out. It's amazing to watch it all, I got to tell you. So let's look at these markets today. So the stock market mix today, the narrow Dow up 71 points. So the Dow climbing 35,630 on the Dow. The S&P 500, the broader market, down 12 points, 45.76 on the S&P, not much of a move there. The NASDAQ down 62 points today, 14,283. So really not much of a market today, kind of the quiet day of the week. We know the data is going to start rolling in tomorrow. Thursday will be the big day. It'll be interesting on Friday to see the jobs created and where they are with their estimates and where the number actually comes in. So I'll be up watching Bloomberg early this week. So let's see where this market goes. I think the market wants to go run. There's a lot of money on the sidelines. Let's see. Bond yields today. Well, what a weird market in bonds today, right? So mixed market, just like stocks. So you got the 10-year jumping 9 basis points. So the 10-year now sitting at 4.05, so 4.05% on the 10-year bond. At the same time, the 2-year comes down 4 basis points, sitting at 4.87%. It wasn't that long ago the 2-year was over 5. Just a weird market. I don't think the bond market really knows where it wants to go right now. I don't really believe that there's a lot of certainty in the bond market as far as what the Fed's going to do. So we're going to get some weird anomaly days like this. I think the 10-year is showing us that they believe rates are going to stay higher for longer. And sooner or later, this yield curve is going to have to adjust and get back to normal. What are rates going to look like when it does? It's going to be fascinating to see it all, guys. I mean, you got an overnight rate at 5.35 now. 10-year rate at 4. Ordinarily, if you have an overnight rate at 5, you'd have a 10-year rate at 7. So I don't know. It's just going to be fascinating to see how it all plays out and how this all works, because everything creates ripples, right? You drop the pebble and ripple, 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 ripple. These higher rates are not going to be good for our government, man. These rates tough, man. This debt servicing, expecting rates to be super low forever, I guess not a great strategy. And we're going to pay the price. The dollar today up again, strong dollar, 102.25 on the index. As I've been saying, right now the dollar is the king of the hill against a whole bunch of other crap. It's not, it's like I don't know, bronze medal in the Special Olympics, because most countries are not really, you know, the currencies around the world are pretty diluted. There's not much competition for the dollar in this basket, at least, so the dollar holding up strong. At the same time, that strong dollar knocking metals down today. Gold down $21.60. Tough day for gold, settling at $1,943.90 for an ounce of gold. Silver down, not as dramatically, down 47 cents per ounce, $24.25 for an ounce of silver. So, I mean, these prices are still pretty sturdy. Strong dollar always going to have an, you know, inverse effect on gold and silver. I still think that we're in the kill zone to see 2,000 gold and $25 silver and stay there. I think that's where we're heading. That's where we'll end up. Oil today, down very small. Down day for oil, down just 9 cents a barrel, sitting at $81.71. It's going to be fascinating to see how oil plays out over the next couple of weeks. As we've been following this, we've been watching it stay in that trough between 70 and 75. It's broken out now, 81.71. Let's see if it can stay or it just falls right back into its regular pattern. If I was laying a little bit of money on this, my bet would be on back down to the trough soon. Bitcoin today up very small, $16.56, sitting at 29,211 for Bitcoin, holding up strong. Bitcoin is good. All right, so let's talk about news you guys need today. So every day, you know, your host, I'm an old fart, right? So I'm still a newspaper reader. So every day I read my local newspaper here in Vegas in the Wall Street Journal. And I was reading this article in the journal that really got my attention. An article regarding this coming real estate collapse, which we've been talking about a little bit on this show, trying to give you guys an idea of what's coming and what the effects of that are going to be. This article was interesting because it kind of put it all really in perspective as far as what is happening in commercial real estate and giving you a, you know, when you hear it's going to crash, you hear that so much about so many things. When you hear things are bad, when you know, this is just like we're conditioned to that kind of stuff. But looking at these numbers, when you look at the numbers here, it's really kind of crazy, okay? So this was the story of the Crystal Mall. The Crystal Mall, it's in Connecticut, and now what the heck town is it in here? It's in Waterford, Connecticut, okay, in the hub of the town, basically. They recently handed back the keys and defaulted on their mortgages, on the debt attached to the real estate. Now, by itself, you know, a mortgage default, a commercial loan going upside down is not big news, especially because we know it's coming and has been happening in commercial real estate. Looking at the numbers here, though, this is going to show us and really give us a feel for the depth of this disaster that's literally getting closer and closer every day. Okay, in 2012, the Crystal Mall, so just about 10 years ago, the mall was valued at $153 million for its appraisal. The owner of the property was a group, Simon Property Group, a big group here in the U.S., been around a long, long time. And Simon had loans about $81 million. Actually, that's up until recently, attached to that property, with about $70 million plus in equity on it. A pretty nice investment, right? You know, you got a piece of property there, it's worth $153 million, you only owe $80 million on it. Simon's owned this property since 1999, so obviously had a very steady return on this property over the years. When COVID hit, well, that changed everything around. So the company stopped making their payments, and that was not uncommon either, okay? Well, they never resumed making those payments. And just recently handed the keys back to the bank. That's it, it's over. So they walked away from this property, walked away from what used to be $70+ million, and handed the keys back. Now listen to this. At auction, the foreclosure auction, the property sold for $9.5 million. That gives you an idea of the depth of this crisis that's coming. You had a property that was worth $150 million that sold for $10 million. And it was that 95% collapse in the price of that property. I mean, these kind of numbers are just absolutely devastating. And they give us a preview, a really good, sharp preview of what's coming. Now listen to this, guys. There's a lot more of this to come. Over the next 12 months, there's $14 billion in loans due attached to properties just like this. $14 billion. Well, if you're owed they owe you $81 million on the property, and you sell it for $9.5 million, that's a pretty big haircut. Percentage-wise, you know, what is that, about 70% haircut? So this $14 billion, if they lose half of it, that's a $7 billion wipeout, man. The brunt of this is going to fall onto the regional banks. You know, losses that are just going to be incredible on what used to be one of the very best investments you could make. Now, I don't think right now we're even a little bit prepared for this. The banks aren't really prepared. The Fed's not really speaking of it. It's all coming closer and closer. News leaking out little at a time. But they're not really ringing alarm bells on this, which is surprising to me. So I'm thinking what we're going to end up seeing here, because of our lack of preparation, as always, we're going to see another big government intervention. And the government is going to become a giant landlord of failed commercial properties. It's either that or regional banks take a giant, they end up going extinct like the dinosaurs, and the majors, the big banks who are waiting on the sidelines, buy all them up and cherry pick the assets they want. Regional banks already having a tremendous bit of, we saw what's been happening. We've talked about it on the show. This kind of loss is just going to finish the job. So some big, big, big stuff coming. A couple quickies. Money markets. Highest yield in 22 years. Highest yield since before the dot-com bubble. You know, not a big surprise. Tons of money moving into money markets. $472 billion moving into money markets just since March, man. So what is that? You know, March, April, May, June, July, 5 months. So about $100 billion a month moving into money markets. Money markets now sitting on record balances, $5.5 trillion in money market accounts. A lot of dry powder on the sidelines. I wish a little more of that dry powder was mine. But 5.5 trillion, if this bull market takes off, a lot of money sitting on the sidelines to push stocks to who knows what kind of levels. Another quickie, job openings today. You know, we got news coming later this week on jobless claims. Well, job openings finally coming down a little bit, down to 9.58 million jobs. We're down to 1.6 job openings for every person looking for a job. That's down from a peak of 1.9, or almost 2 jobs for every person. So I think the Fed's having its way little by little. Employment, we'll see on Thursday. Is employment really cooling off? I don't know. But lots of dry powder on the sidelines. Money market yields up. Inflation numbers coming down. We saw late last week that the PCE coming down pretty dramatically for the Fed. Interesting times, guys. We're going to write books about this stuff. You'll see. Anyway, that's it for today. We know tomorrow starts the big push to finish the week. We'll be back to bring you guys the news you need. As always, if you like what you're hearing, please hit the like button. It helps change the algorithms around, gets our video out to our video in front of more viewers. Hit me up with your questions and comments. We'll be back to tomorrow. Until then, guys, take care. Thanks.